Social media chatter about a silver shortage should be treated with a healthy dose of skepticism. This was the statement issued by the Perth Mint, Australia's Perth Mint, back in March when there was online chatter that the Mint was having trouble fulfilling physical redemption from their unallocated or certificate program. It's now April and the rumors have not abated. In fact, they've grown and spread outside of the Perth Mint to other mints, to bullion dealers. And joining me today to talk about unallocated accounts is Vince Lanci. He is the founder of EchoBay Partners, also a frequent contributor to Zero Hedge. Vince Lanci, good to see you.
Good to be seen. Thanks, Danny.
So I just want to start by saying we're not here to investigate, the Perth Mint and whether they're right or wrong or whether there's truth to the rumors. The bigger issue for me to discuss here is when it comes to purchasing physical metal, right? Precious metals. Are you best buying physical and taking delivery versus looking to a storage account, unallocated pool, whatever you want to call it? So that's what I want to discuss with you today. It's a big topic, but I think it's an important one, right, Vince? Timely.
Sure. Yeah. I mean, I can give you a bullet answer right now.
Well, let's go for it. Like when it comes to precious metals, do you want physical or do you not mind unallocated? Of course, there's pros and cons to both, but how do you take it?
Right. Well, first of all, just to get out of the way, there's a price to do everything. So if you're doing unallocated metal, then if there's a discount of enough price, if there's enough of a deal, you would do it. But I think what people need to hear is this. If you're using zero leverage in your investments in physical metal, then why would you store it anywhere else except with yourself? If you're using leverage, the amount of leverage you use should be commensurate with the amount of risk you take. Meaning, when you use leverage on an account, the other counterparty has risk. So, maybe you can't make the margin call. So you're using leverage, that's protecting you on an unallocated account. Everything else has to be allocated. What I'm getting at is if you're not using leverage, why wouldn't you just take it?
I want to ask you this, because I just continue reading the statement from the Mint. They said, while the Perth Mint is currently experiencing increased demand for its products and services, customers can still invest in leading Australian silver bullion coins and in pool allocated or unallocated silver via our depository. So basically, the mints are having trouble fulfilling demand. Okay.
Right.
Do you buy that narrative?
There are a couple factors that really matter. One is, and we can touch on this if you want to, but this started in March 2020, not last March. And the actual dealers and mints, they're having a problem because, and you're speaking specifically about silver, yes, demand is up. Yes, they're having a hard time fulfilling it in the forms that are being asked for. The Spider-Man commemorative coins, you could probably get as many of those as you want, but that's not what people want. So it's the form that's causing the problem. I'm not saying there isn't a disproportionate amount of demand, and that there really is kind of a run on the fractional reserve banking mentality of silver. But I am saying that if you want 1,000-ounce bars, and that's what everyone wants, and they only have 330-ounce bars or whatever they are, then you're going to have a refining issue, and you're not going to have enough metal on hand. So when you go to the Perth Mint or any other mint and you say, I want, Australian coins, and they don't have them, then they'll try and give you something else. And if not, you have to wait. So it's a matter of form and venue that is the problem. But there is going to be a bigger problem, I think.
Okay, I want to know from you, do you trust that behind every certificate account, pool account, there's silver to back it for every client?
No, I don't. I would say that before there was a perceived problem. If you look at how firms have been operating with their accounting procedures for the last, 20, 30 years, there is a scandal that pops up every 3 months. I do not think that the intention is to defraud people, but I do think that counterparty risk and sloppy accounting or bad accounting or robbing Peter to pay Paul have been endemic in certain industries that aren't profitable enough to pull a lot of metal out of the ground. So I'm not saying that this dealer's bad or that mint is bad. I'm saying there are going to be problems. There are going to be errors, and whether it's errors or cover-ups from the previous administration that runs a company. But I don't think I can say very confidently that you don't have a one-for-one correlation with silver that's available in the form you want it and
right.
Demand if everybody wanted to.
Let me ask you this, but if you have no interest in ever taking physical possession of the metal, right? Let me pose the question that way. If you have no interest in ever taking physical possession of the metal, right, then are you better off looking at unallocated because of course you have lower premiums, lower storage fees? Is that?
That's actually, everyone says this, but that actually is a really good question. If you're not interested in taking physical delivery, then what's the problem? Well, there is a problem because if you're buying a contract, whether it be an ETF or a pooled account or something that if you're not taking physical delivery, then your intention in buying an asset like silver is you want the instrument to track the price. The instrument will track the price, and it will track the price better if it's transferable into physical delivery, which means if there is a crisis and an exchange or a mint or a bank goes under or someone defaults or there's a scandal like there was in one of those refiners years ago, I think out of Florida. If those things happen, then what's happening is you're tracking the asset's ability to track physical metal decouples. So what ends up happening is you have like, for example, and I'm not saying this is happening, but if an exchange has a physical settled silver contract and that exchange says, oh, we don't have enough silver, and it's not what I'm talking about, but this is what happens. An exchange can decouple and settle the contracts in cash. So what ends up happening is you will have a two-tiered market. Tracking the stock, the silver asset that you're long, that you don't take delivery of, it will track silver, but at an inherent discount to the actual market. So you will lose money.
Let's apply this thought process now to Bitcoin. Okay. And I ask this because we're seeing the emergence of Bitcoin ETFs. Now, yes, you cannot, Bitcoin, you cannot take physical possession. You cannot touch Bitcoin, but does the same philosophy apply, Vince, for you? When you're looking at investing in Bitcoin, would you only go direct Bitcoin versus an ETF?
I'm not a fan of Bitcoin ETFs, and that's not because I distrust the companies. I don't think that they're representing that they have more Bitcoin than they say. I think what's happening is because there's such a huge demand coming into the asset that a new ETF will trade at a premium, and then when a competitor gets listed, that ETF that had all the demand will lose demand, and then it'll trade at a discount. But to answer your question directly, how does that apply? Well, first of all, not to contradict you, but if I own Bitcoin in a wallet, it's mine. It can't be reloaned. It can't be allocated. So me having Bitcoin in my own, Bitcoin wallet is something that can't be reloaned out. Now, do I think these trusts for Bitcoin are going to do that? I think you have one listed in Canada now. Mm-hmm. And the answer is, I don't think they're going to be doing that at all because they're too new and they're, the accounting procedures, they don't have legacy problems like I think these silver companies do. I don't think that's a problem. The problem for Bitcoin in terms of this whole, what's the word, rehypothecation problem is that when the futures start to get a lot more traction, you're going to see 5 and 10 contracts sold for every one Bitcoin that exists. So the problem will be the similar problem that you have on the COMEX for short plays being more dominant over long plays. But I don't think, this is me guessing, right? Okay, so everyone has to do their own due diligence. I don't think a Bitcoin ETF is going to be a problem for allocation versus unallocation. These trusts, I think, are being very well monitored because they're early in the game. I hope that helps.
Yeah, no, totally. And I just want to end this trifecta now by taking it one step further and bringing up, investing in stocks, right?
Right.
You're also not getting, you're not really taking the piece of the company home.
Yeah.
So how does it, how is this all different to owning stocks?
Well, I think if there are 100 shares of a stock, let's say it's GameStop, right? That's the one everyone is familiar with. If there's 100 shares of a stock, then only 100 shares can be shorted. Mm-hmm. In order to short more than 100 shares, you have to create those shares that don't exist. So there's a limit to how much of the float, that's the term, that can be shorted. Now, there are ways around this, and banks have violated that rule on SEC regulated assets. I think it's insane to not think those rules are not being violated on international commodities like silver. They just are. You know, I'm betting on that, right? But to answer your question, stocks usually have a mechanism built in that prevents them from being overly hedged or rehypothecated. Or, for example, if you don't want someone to short your stock, you can take delivery of it. And it's as easy as getting an electronic receipt or getting a physical share. Silver, you have to get the physical in front of you these days, because we don't trust any counterparty risk at all. So the difference between silver and stock, or commodities and stock, is this: stock is more tightly regulated. Investors in financial assets can get their shares because it's a financial asset on a financial asset. And they have tried to create the ability to have more liquidity in these futures markets. And what's ended up happening is it's been used to be overly shorted. And so as a result of that, if everyone wanted their shares back of GameStop, right, there wouldn't be any shorts. So everyone had their shares in their possession. That's fine, right? But if everybody wanted their shares of silver back, there isn't enough silver ready to go. That's the bottom line. So there's a difference.
Really good thoughts from you here today, Vince. Before I let you go, how can I not ask you? Are you going to be buying any silver anytime soon?
Yeah, I think I'm going to be in the market for a 500 coin box of silver. Yeah, I think I'm going to be doing that. And part of that is I want to see how the process is going. And part of that is I want to see what the premiums are and if they're justified. But yeah, I think I'm going to be buying some now.
So you know what? We're going to follow up with you, and you're going to walk us through how that process went. Sound good? You'll tell me.
Sure, absolutely. We'll be doing that.
Awesome. Thank you so much, Vince.
Thanks for having me.
Yeah, and thank you for watching this edition of StansberryInvestor.com. We'll have much more for you, so be sure to stay tuned. In the meantime, remember to share us where you watch us. That's it for me today. I'm Daniela Cambone.